everyone and welcome to another lecture on ratio analysis and interpretation of financial statements. Today we are going to study another category of ratio, and that is liquidity ratios. First of all, we need to understand what liquidity ratios are. Liquidity basically means the company's ability to pay off its short-term debts on time. You see, when the business is running as a going concern, it normally operates by buying raw materials on credit along with other short-term supplies. And when you buy something on credit on short-term basis, you need to be able to pay it on time. And if you don't, your future supplies can be affected, or your supplier may take you to the courts, exposing you to the voluntary winding up, right? So liquidity is important, and mainly short-term lenders generally look at your liquidity ratios to assess whether you are viable in the short run or not. One of the first ratio that we are going to discuss here is the current ratio. The formula for the current ratio is you take your current assets in numerator and your current liabilities in the denominator. For example, if you have $10 of current assets against $5 of current liabilities, your answer would come out as 2, which you would denote as 2:1. Essentially, this ratio tells you how much current assets are available to settle each dollar of your current liability. The higher the current ratio, the more it tends to impress the short-term lenders, as they feel safer when a company has more current assets to easily pay off its current liabilities. However, remember that current ratio only denotes the short-term liquidity of the business. It does not reflect the long-term viability of the company. It is possible for a company to appear liquid in the short term because it has taken on substantial loans, thereby temporarily boosting its cash levels. Typically, your current assets primarily include inventories, receivables, and cash equivalents. So it is easy to improve your short-term liquidity position simply by taking out a loan. For example, if you observe in the financial statements while solving a question that company has taken a fresh loan note towards the end of the year, this will beef up your cash, and hence your current asset will appear more than adequate compared to your current liabilities and showing off a good liquidity position. But you need to be mindful that this only reflects a short-term impact. There is a good possibility that if the company cannot utilize this money effectively, it will be wasted, leading to losses, and ultimately you may not be able to pay off your debts in the near future. A good current ratio might seem promising. It does not necessarily mean that the company will survive in the long run. You need to keep this in perspective. For example, if you have a current ratio of 10:1, you might say that you are in a very good position in the short run. Only $1 of current liability for each $10 of current asset, indicating a safe company. However, a 10:1 current ratio might also be somewhat risky for the business. Always remember, there is an inverse relationship between liquidity and profitability. The more liquid a company is, the less likely it is to be profitable. This is because if a company's money is tied up in current assets like inventories or receivable without generating sales, it is not earning a profit. Having an excess amount of cash does not mean that the company is performing well. It may suggest that company is missing opportunities for profitability by not investing in current assets such as property, plant and equipment that could generate returns. On the other hand, if you ever get an answer of current ratio less than 1, for example 0.5 to 1, this indicates a risk for your lenders. It means that for every $1 of current liability, the company has $0.5 in current assets, which could be concerning for your short-term lenders and suppliers. Also remember that current ratio can fluctuate over the years. It might be higher or lower compared to another company, or it may not match the industry average. In your exam, you need to come up with reasons that justify the movement of your current ratio over the period compared to another company or compared to the industry average. So you need to work on that. Now, when analyzing the current ratio in your exams, you need to identify potential reasons that might affect your current ratio. For example, you need to find out some accounting factors. Accounting factors are not real business reasons, but these are reasons that eventually affect the ratio. Accounting manipulations can significantly affect the outcome of your ratio analysis. And one of the common manipulation is the maintenance of high inventory levels. This practice can artificially inflate the current ratio, suggesting better short-term liquidity than might actually be the case. So later on, we will be studying something which is known as inventory days. Inventory days tells us how fast we are able to sell our inventory. Now, if your exam question reveals that while the current ratio is increasing and the inventory days are also increasing, this might indicate that the company is not able to convert its inventory into sales. And this is a clear sign that while liquidity might seem adequate, the company might actually be facing sale inefficiencies or market demand issues. In your exams, you need to closely examine the absolute amount of inventory listed on the balance sheet. Higher inventory levels contributing to an increased current ratio could mislead about the actual liquidity health. You need to determine whether high inventory is due to poor sales strategies or perhaps overproduction, both of which could pose significant business risk. Another critical accounting factor that can influence current ratio is the increase in receivable days. This can partially improve current ratio while potentially indicating underlying financial inefficiencies. Receivable day measures how long it takes for a company to collect cash from their credit sales. If a company extends longer credit terms or struggles with debt collection, receivable days will increase. Now, imagine you are analyzing a company and you observe that its current ratio is improving over time. At first, this suggests improved short-term liquidity, indicating that the company has sufficient current assets to cover its short-term liabilities. However, if the increase in current ratio is driven because of rising trade receivables, this might be misleading. In your exam, if you see an increase in receivable days along with the increase in current ratio, you should check whether the liquidity improvement is genuine or if it is due to poor receivable management. If receivable days are rising significantly, it could indicate delayed collections from the customers, leading to potential cash flow issues. If customers are taking longer to pay, the company may be struggling with credit control, extended credit terms excessively, or facing declining customer financial health. A sharp increase in receivable days without a corresponding increase in revenue growth could suggest bad debt risk, which may eventually lead to write-offs and reduce profitability. On the other hand, if the company is aggressively increasing sales by offering extended credit terms, this might be a short-term growth strategy, but it could backfire if those receivables become difficult to collect. When evaluating financial ratios in your exam, always cross-check receivable days with the current ratio to determine if the liquidity improvement is genuine or artificially inflated. Also, often in exams, the detailed breakup of current assets might not be provided, which can limit your analysis. Financial statement might only show a lump sum of current asset without detailing how much is in cash, receivables, or inventory. In such cases, it is beneficial to mention in your answer that a more detailed breakdown would enable a more accurate analysis of the current ratio. Highlighting this limitation can demonstrate your understanding of thorough analysis and the importance of detailed data. If detailed information is not available, suggest in your answer that having such data would help in better analyzing the impact of current ratio. This approach shows your critical thinking and understanding of how detailed information contributes to more robust financial analysis. You need to utilize whatever information is available to draw conclusions about the changes in current ratio. For instance, if inventories or receivables are increasing, or if there is an unusually high amount of cash, these factors could be driving changes in the current ratio. Discuss these elements in your answer to provide a comprehensive evaluation. By employing these strategies, you can effectively comment on the current ratio in your exam, demonstrating both your analytical skills and your ability to critically assess financial health from the available data. This approach not only helps in scoring well, but also prepares you for the real-world financial analysis. When analyzing the current ratio in your exam, it is also important to base your analysis on concrete business reasons that are provided in the question rather than inventing reasons yourself. Here is how you can approach this effectively. First, read the question carefully. Ensure you understand every detail of the exam question. This will help you identify the logical business rationales influencing the movement in current ratio. Take your time to read slowly and thoroughly to understand all the angles of the scenario provided, and then examine the company's profitability trend as mentioned in the question. If the company has been incurring losses for the past few years, this would likely impact its current ratio. A continuous lack of profit means that expenses are not matching or exceeding incomes, leading to little or no residual cash. Lower cash reserve will naturally result in declining current ratio as the company struggles to maintain liquidity. You also need to look for any significant investments mentioned, such as investment in plant and machinery or acquisition of a subsidiary towards the year end. Such transactions often involve large cash outflow, which would directly decrease cash balance and adversely affect the current ratio in the short term. But remember, these strategic decisions could potentially damage the current ratio in the short term, but it might be beneficial for the company's future. For example, acquiring a subsidiary might drain cash reserves initially, reducing the current ratio. However, if the subsidiary is profitable, it could enhance the parent's company's financial position in the future through synergies and additional profits, eventually helping to improve liquidity. Whenever you identify a significant business decision like an investment or acquisitions, discuss how this affects the current ratio and the broader financial health. Acknowledge both the immediate financial impact and the potential long-term benefit to provide a balanced view. Basically, you have to use logical reasoning to connect the dots between the business activities and their impact on the current ratio. And by grounding your analysis in this manner and focusing on the real business reason, you can provide insightful, well-reasoned answer that demonstrate a deep understanding of how business decisions impact financial ratios like the current ratio. Now, when assessing liquidity through the current ratio, it is crucial to understand the component of both current assets and current liabilities, and in particular, the role of overdrafts. When analyzing the current liabilities, note how much of it consists of bank overdraft. Overdraft is crucial to consider because it can be called for repayment on demand by the banks, and this is different from other liabilities that may have longer payment terms such as 30, 60 or 90 days. This on-demand repayment nature of overdraft increases the financial risk associated with the overdraft. If a significant portion of your current liabilities comprises of overdraft, let's say 70%, this signals a high risk. Even if your current ratio appears satisfactory, the fact that the major chunk of your liabilities consist of overdrafts can expose the business to severe liquidity risk. The bank can demand these funds at any time, potentially destabilizing your liquidity position if it is not managed carefully. Alright, my friends, let's now address the limitations of the current ratio, especially for businesses with slow moving inventory. For instance, in industries like housing construction or automobile manufacturing, the inventory comprising of under construction projects or unsold vehicles may inflate the current assets. However, these high value items are not quickly convertible into cash to meet short term obligations. Thus, while the current ratio might suggest sufficient liquidity, the realizable value of these assets in the short term may be quite limited. Given this limitation, we turn to another metric, the acid test ratio, or known as the quick ratio. This ratio is more strict measure of liquidity. It is calculated by taking current assets, subtracting inventory, and then dividing by current liabilities. This adjustment of excluding inventory from the current asset focuses only on more liquid assets, that is receivables and cash. The acid test ratio is particularly useful for business with slow moving inventory like automobile, real estate, etc. However, for a FMCG company, fast moving consumer good companies, or a supermarket like Walmart, most of their funds are tied up in inventory, which means their quick ratio might appear low if inventory is excluded. These businesses typically invest heavily in their inventories. Therefore, for such companies, quick ratio or acid test ratio is not suitable. Thus, when examining financial health in your exam or in real world scenario, you need to consider which ratio best reflects the company's situation and always be mindful of the nature of assets involved. Remember, if there is insignificant gap between the current ratio and the quick ratio, this usually denotes high inventory level. Sometimes in your exam, the examiner may not provide specific details but give you a current ratio of, for example, 5:1 and a quick ratio of 1:1. Here, it is easily understood that current ratio is inflated because of high inventory balance. The substantial difference between the current ratio and the quick ratio clearly indicates that the current ratio was highly inflated due to inventory, posing a risk to lenders and investors that company is not efficiently selling their inventory and is maintaining high inventory levels. This is how you need to identify risk in your exam. Not every time you will need to calculate a ratio from scratch. Sometimes your examiner will provide pre-calculated ratios and you need to interpret them. In short, current ratio indicates short-term liquidity under normal conditions, while the acid test ratio or the quick ratio provides a strict measure by excluding inventory from the current assets. Alright, my friends. So far, we have explored the current ratio and the quick ratio in greater detail. These ratios are fundamental in evaluating the company's liquidity and the company's ability to meet its short-term obligation. However, as with all financial metrics, liquidity ratios have limitations, and one of the most critical issue here is maturity mismatch. Now, what is maturity mismatch? Maturity mismatch occurs when the timing of cash inflows from current asset does not align with the timing of cash outflows required to settle the current liabilities. The current ratio and the quick ratio assume that all current assets can be converted into cash in time to meet all the current liabilities. But in reality, this is not always the case. For instance, a company may report a healthy current ratio of 2:1, suggesting that it has twice as many current assets as current liabilities. However, if a significant portion of current assets consist of trade receivables that are due in 90 days, while a large portion of current liabilities such as supplier payments or short-term bank loans are due in 30 days, the company may still face serious liquidity problems, even though it appears to have a strong current ratio. For example, consider a retail company that has the current assets of $2 million. Out of this, inventory is $800, cash is $300, and trade receivable is $900. Majority of the trade receivables are due in 60 to 90 days. On the other hand, current liabilities of the company are $1 million. This current liability comprises of trade receivable of $700 due in 30 days and short-term bank loan of $300 due in 20 days. At first, the company has a current ratio of 2:1, meaning that for every dollar of liability, it has $2 in current assets. This would typically be interpreted as safe liquidity position. However, if we assess the maturity profile of these assets and liabilities, a major issue arises. Receivables of $900,000 are not immediately available. They are expected to be collected in 60 to 90 days, whereas inventory of $800,000 is not guaranteed to be sold quickly, and even if sold, it might be on credit, further delaying the cash collection. And immediate cash available is only $300,000, while the company needs to settle $1 million obligation, $1 million in liabilities within 30 days. So despite a high current ratio, this company may not be able to meet its short-term obligation without borrowing more money or negotiating extended payment terms with the supplier. This is the classic case of maturity mismatch. Assets are available on paper, but not in a timely manner. So a high current ratio or high quick ratio does not always mean a business is liquid. The timing of cash inflow and timing of cash outflow must also be considered. Liquidity must be analyzed in conjunction with cash flow forecast, not just the balance sheet figures. And business should ensure that their short-term liabilities do not significantly outpace their short-term cash inflows. They may negotiate better credit terms with the supplier to align payment schedules with their revenue cycle. And if after doing all this, a company faces a maturity mismatch, it may secure a revolving credit facility or line of credit to bridge cash flows gap. My friends, understanding liquidity requires more than just calculating ratios. It requires analyzing timing mismatches between assets and liabilities. A high current or quick ratio does not always mean a company is financially healthy. In real-world business scenarios, companies must ensure that they have enough immediate liquidity to meet short-term obligations, even if their financial statements represent a strong liquidity ratio. Alright, my friends, as we wrap up our lecture on liquidity ratios, I hope you now have a clear and comprehensive understanding of how these ratios function and why they are crucial for financial analysis. We have explored the current ratio, its strengths, limitations, and potential accounting manipulations. And we have seen how inventory levels, receivable days, overdrafts, and maturity mismatch can impact liquidity analysis. We also introduced the acid test or quick ratio, which provides a strict assessment of the company's ability to meet its short-term obligation by excluding inventory. So the final takeaways are that liquidity is not just about high ratios. It's about whether the company can convert its current assets into cash when needed. A strong current ratio does not always mean financial stability. It must be analyzed alongside other factors like inventory movement, receivable collection, and reliance on overdraft. The asset test ratio is a better measure in certain industries, especially when slow moving inventory can distort the current ratio. In your exam, instead of just calculating numbers, interpret the story behind the ratios to identify potential risk and financial health indicators. Remember, ratios tells us a lot, but they don't tell us everything. Always connect financial ratios to business realities and apply your analytical skill to assess whether a company's liquidity position is genuinely strong or is artificially inflated. With this knowledge, you are now better prepared to analyze liquidity ratios in both your exams and real-world financial evaluations. This concludes our discussion on liquidity ratios. Keep practicing, keep questioning, and always look beyond the numbers. Thank you for watching and see you in the next lecture.